What if I told you there is a book that turned $1,000 into $5 billion? Not a crypto scheme. Not a get-rich-quick trick. A book written in 1949. The man who read it as a 19-year-old said it completely changed his life. That man was Warren Buffett. He called this book the best book on investing ever written. He still calls it that today. And here is the wild part. Most people who buy this book never finish it. They get bored. They put it down. They miss the most important financial lessons ever written. You are not going to make that mistake today, because in the next 30 minutes, I am going to break down every single lesson that matters. Simple, clear, no confusing finance words, just the raw ideas that have helped ordinary people build extraordinary wealth. So stay with me, because what you are about to learn could literally change the direction of your financial life. Intro and promise. The book is called The Intelligent Investor. The author is Benjamin Graham. He was Warren Buffett's teacher, mentor, and hero. Buffett has said publicly that everything he knows about investing came from this man. Benjamin Graham lived through the Great Depression. He watched people lose everything. He saw families destroyed by bad financial decisions. And he spent the rest of his life figuring out how to make sure that never happened to him or anyone else again. What he wrote in this book is not a trading strategy. It is not a hot stock tip. It is a philosophy, a way of thinking about money that protects you while growing your wealth at the same time. Here is what you are going to take away from this video. You are going to understand why most investors fail and why you do not have to. You are going to learn how to think about the stock market in a completely new way. You are going to get real, actionable tools you can start using immediately. And later in this video, I will reveal the one insight that completely changed how Benjamin Graham thought about risk. Once you hear it, you will never look at investing the same way again. It is that powerful. Let us get into it. Lesson 1. The stock market is not your enemy. It is a moody business partner. Imagine you have a business partner. His name is Mr. Market. Every single day, he shows up at your door and offers to buy your share of the business or sell you his share. Some days, Mr. Market is in a great mood. He is optimistic. He thinks the future is bright, so he offers you a very high price. Other days, Mr. Market is terrified. He thinks the world is ending. He offers you a ridiculously low price just to get out. Here is what nobody tells you. Mr. Market is emotionally unstable. His prices have nothing to do with the actual value of the business. Benjamin Graham invented this idea. He called it the Mr. Market parable. And it is the foundation of everything in this book. Most people think the stock market is a precise measuring machine. They think if a stock goes down, something must be wrong with the company. They panic. They sell. But actually, the market is more like a voting machine in the short term and a weighing machine in the long term. In the short term, it reflects emotions, fear, greed, and panic. In the long term, it reflects real value. Let me give you a real example. In March 2020, the entire stock market crashed. Companies like Amazon, Apple, and Microsoft lost 30 to 40% of their value in weeks. Nothing changed about those businesses. They still had the same products, the same customers, the same revenue streams. But Mr. Market was panicking. The people who understood Benjamin Graham's lesson did not run away. They saw it as a sale, a massive clearance event on great companies. Here is your actionable takeaway from this lesson. The next time the market drops and everyone around you is panicking, ask yourself one question. Has the actual value of this business changed, or is Mr. Market just having a bad day? That one question separates intelligent investors from everyone else. And once you understand how to read Mr. Market's mood swings, you are ready for the next big lesson. Because it turns out most people do not even know what kind of investor they actually are. Lesson 2. You are probably not an investor. You are a speculator in disguise. Here's a question. When you buy a stock, what are you actually doing? Most people think they are investing. They are picking a company. They are putting money in. They are waiting for it to grow. But here is the truth that will sting a little. If you are buying a stock because you think the price will go up next month, you are not investing. You are speculating. Benjamin Graham makes a very sharp distinction here. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Everything else is speculation. Read that again. Safety first. Adequate return second. Not maximum return. Adequate. This changes everything about how you think about the stock market. Most people get this wrong. They buy a stock because their friend mentioned it, because they saw it trending on social media, because a YouTube thumbnail told them it was going to the moon. That is speculation, not investing. And here is the counterintuitive twist. Speculating feels exciting. Investing feels boring. But boring is exactly what makes you wealthy over time. Think about it this way. Imagine two people. Person A checks their portfolio every day. They buy and sell based on what they read online. They feel like they are in control. They feel active, engaged, and sharp. Person B puts money into solid, undervalued companies every month. They barely check their portfolio. Their strategy is almost painfully boring. In 10 years, research consistently shows that person B wins. Not because they were smarter, because they were disciplined enough to stop speculating. Here is your actionable takeaway. Before your next investment, answer 3 questions. 1. Have I analyzed this company? 2. Is my principal reasonably safe here? 3. Is the expected return realistic and sustainable? If you cannot answer all 3, you are speculating, not investing. This distinction is not just academic. It is the difference between building wealth and gambling with it. Now, once you know you are truly investing and not speculating, you need to protect yourself. And that brings us to one of the most powerful ideas in the entire book. Lesson 3. The story of a man who never lost money. Let me tell you about a real investor named Walter Schloss. Walter was not famous. He never went to Harvard. He worked quietly in a small office in New York. He did not have fancy computers or a team of analysts. He had one tool, the lessons he learned from Benjamin Graham. Over 45 years, Walter Schloss delivered an average annual return of over 15%. He beat the market year after year, decade after decade, through crashes, recessions, and booms. His secret? He never paid full price. He called it the margin of safety, and it is the single most important concept in The Intelligent Investor. Here is how it works. Imagine a bridge. Engineers say it can hold 10,000 pounds. But you are not going to drive a 10,000-pound truck across it. You drive a 6,000-pound truck. That 4,000-pound gap is your margin of safety. Benjamin Graham applied this exact thinking to stocks. If you analyze a company and decide it is worth $100 per share, you do not buy it at $100. You wait until it drops to $60 or $70. That gap between what you paid and what it is worth is your margin of safety. Why does this matter so much? Because you will be wrong sometimes. Even the best analysis has errors. Markets are unpredictable. Bad things happen to good companies. The margin of safety is your financial cushion against being wrong. Here is the emotional truth behind this lesson. Investing is an act of humility. It means admitting that you do not know the future. It means protecting yourself from your own mistakes before they happen. Walter Schloss understood this deeply. He never tried to hit home runs. He just refused to strike out, and over 45 years, not striking out consistently turned him into one of the greatest investors who ever lived. Your actionable takeaway is this. Never buy anything at full price. Always ask yourself what the downside is if you are wrong. Make sure the price you pay leaves room for error. Margin of safety is not just a financial concept. It is a life philosophy. And once you start applying it, everything changes. Now here is where things get really practical. Because Graham does not just give you a philosophy. He gives you a specific type of investor profile to follow. And figuring out which one fits you is the key to making this all work in your real life. Lesson 4. Are you a defensive investor or an enterprising one? Get this wrong and it all falls apart. Benjamin Graham divides all investors into 2 types: defensive investors and enterprising investors. And the difference is not about how smart you are. It is about how much time, energy, and effort you are genuinely willing to put in. The defensive investor is someone with a busy life. They have a job, a family, a full schedule. They want to invest wisely, but they cannot spend hours researching stocks every week. Graham respects this completely, and he builds an entire strategy just for them. The enterprising investor is someone who is genuinely passionate about markets. They enjoy research. They are willing to put in serious time and effort to find undervalued companies. They treat investing almost like a second job. Here is what nobody tells you. Most people think they are enterprising investors. They are not. They start with big ambitions. They research a few stocks. They spend a weekend on YouTube. And then life gets busy and the research stops. But the risky investments stay. That is a dangerous combination. Graham's advice is brutally honest. Be honest about who you are. If you are not going to do the work consistently, do not try to act like you will. Be a defensive investor and do it properly. For the defensive investor, Graham recommends a simple, powerful strategy. Split your money between high-quality stocks and high-quality bonds. Roughly 50-50. Rebalance when the market swings hard. Buy index funds that track the whole market. Keep your costs low. And almost never make dramatic moves. That is it. That is the entire strategy for a defensive investor. And it works. Decades of data prove it. Your actionable takeaway for today is this. Be radically honest with yourself right now. Are you genuinely going to research individual companies every week? Or do you need a simpler, more automatic strategy? Most people need the simpler strategy. And there is zero shame in that. Here is the powerful curiosity hook I promised you earlier. Because once you know your investor type, there is one more layer to all of this. Graham discovered something about human psychology that explains why even smart people destroy their own portfolios. It is not about strategy. It is about something much deeper, something you probably do every single day without realizing it. And understanding it is going to make everything we have covered so far click together in a way that will genuinely shock you. So do not go anywhere, because what comes next is where things get really interesting. Lesson 5. Your biggest enemy is not the market. It is the person in the mirror. Let me ask you something honest. Have you ever sold an investment because you were scared? Have you ever bought something just because everyone else was buying it? Have you ever checked your portfolio every hour during a market crash? If you said yes to any of those, you are not alone. And according to Benjamin Graham, you were doing exactly what destroys most investors. The number one enemy of the intelligent investor is not inflation. It is not bad companies. It is not even market crashes. It is your own emotions. Graham called this the investor's chief problem and worst enemy, himself. Here is the psychology behind it. When the market goes up, your brain feels good. You feel smart. You want to buy more. When the market goes down, your brain sounds alarms. It screams danger. You want to sell everything and run. But here is the brutal truth. Buying high and selling low is the exact opposite of what makes money. And yet millions of people do it every single cycle because their emotions override their logic. There is a famous study by a research firm called Dalbar. They tracked the returns of average investors over 20 years compared to the market itself. The market returned roughly 9% per year. The average investor returned less than 4%. Same market. Completely different results. The difference was behavior. Average investors kept reacting emotionally. They kept buying when things felt exciting and selling when things felt scary. Here is a real story that hits this hard. In 2008, the stock market crashed nearly 50%. It was terrifying. Every news channel was predicting the end of the financial world. Millions of people sold everything. They locked in their losses. They waited on the sidelines. By 2013, the market had fully recovered and hit new highs. The people who sold in 2008 missed the entire recovery. The people who stayed or bought more during the crash nearly doubled their money. The secret is not picking the right stocks. The secret is controlling your own reaction when things get ugly. Here is your actionable takeaway. Set your investment strategy during a calm moment. Write it down. And commit to not changing it during a market panic. Because the version of you that is panicking is not the smartest version of you. The smartest version wrote the plan before the storm hit. Mastering your emotions is what separates investors who get rich slowly from investors who stay broke forever. And once you have that discipline locked in, you are ready to actually go find great investments. But Graham has very specific rules for what qualifies. And most people have never heard them. Lesson 6. The stock picking rules that made Warren Buffett a billionaire. Warren Buffett has said that chapters 8 and 20 of The Intelligent Investor are the most important things ever written about investing. Chapter 8 is Mr. Market, which we already covered. Chapter 20 is about margin of safety, which we also covered. But in between those two chapters, Graham lays out something incredibly practical. A specific checklist for picking stocks. And it is so clear so logical, and so timeless that Buffett built his entire early career on it. Graham called the stocks that met these criteria undervalued companies. He also called them bargain issues. Today, most people call this value investing. Here is what Graham looked for. First, a company had to be financially strong, not drowning in debt, not one bad quarter away from collapse. Strong balance sheet. More assets than liabilities. Solid and stable. Second, the company had to have a long track record. Graham wanted to see at least 10 years of continuous operations. Not a hot new startup. A proven business that had survived multiple economic cycles. Third, the company had to be paying dividends. Consistently. For at least the past 20 years. This showed financial discipline and real profitability, not just accounting tricks. Fourth, and this is where it gets really interesting, the stock had to be cheap. Not just reasonably priced. Genuinely cheap relative to its earnings and its assets. Graham had a specific formula called the price-to-earnings ratio, or PE ratio. He wanted to buy companies trading at no more than 15 times their earnings. And he wanted the price to be no more than 1.5 times the book value of the company. Now here is what nobody tells you about this checklist. In today's market, very few stocks meet all of these criteria at the same time. The market is often fully priced or overpriced, which means the intelligent investor has to be patient, sometimes for a long time. And patience is hard. Watching other people seemingly make money on exciting new tech stocks while you sit on cash waiting for a bargain is psychologically painful. But here is the historical truth. Every major market crash in history has eventually created exactly the kind of bargains Graham was looking for. The patient investor always gets their moment. The impatient investor is usually the one selling to them at a discount. Your actionable takeaway is this. Before buying any stock, run it through Graham's basic checklist. Is the company financially strong? Does it have a long track record? Does it pay dividends? And is the price genuinely cheap relative to what the business actually earns? You do not have to find a perfect stock. You just have to avoid terrible ones and wait for genuinely good ones to go on sale. And speaking of sales, Graham has a fascinating thing to say about market crashes that most people find completely counterintuitive. In fact, it is the insight I promised you at the beginning of this video, the one that changes everything. And we are almost there. Lesson 7. Why market crashes are the best thing that can happen to you. Close your eyes for a second and imagine this. You walk into your favorite clothing store. Everything you love is 60% off. Every single item. Best brands. Best quality. All of it, marked down dramatically. How do you feel? You feel excited. You grab a cart. You stock up. Now imagine the same thing happens with stocks. The entire market drops 40%. Every great company you have always wanted to own is suddenly 40% cheaper than it was 6 months ago. How do most people feel? Terrified. They run away. They sell what they already own. Do you see the insanity of that? We celebrate sales on clothes and electronics. We panic during sales on wealth-building assets. Benjamin Graham called this one of the most predictable and self-destructive patterns in all of human behavior. Here is the insight that changed everything for Graham. A market crash does not destroy value. It destroys price. Those are completely different things. The value of a great business, its products, its customers, its brand, its earning power, does not disappear when the stock price drops. Only the price tag changes. The underlying reality stays the same or continues growing. This is why Warren Buffett famously said that he hopes the market crashes regularly, because every crash is a shopping opportunity for someone who has done their homework and has cash ready. Let me give you a real example that will make this viscerally clear. In 2009, at the absolute bottom of the financial crisis, you could buy shares of Bank of America for under $4. In 2023, those same shares were worth over $30. Someone who invested $10,000 at the bottom walked away with over $75,000. They did not need a genius strategy. They just needed to understand that the crash was a sale, not a catastrophe. Here is what nobody tells you about crashes, though. They feel completely different when you are living through one. Reading about past crashes in a book feels intellectual and calm. Being inside a crash, watching the news, hearing your friends panic, seeing your account balance drop, that feels genuinely terrifying. This is why preparation matters so much. You have to decide before the crash how you are going to respond during the crash. Because in the middle of it, your emotions will lie to you. They will tell you this time is different. They will tell you everything is collapsing for good. They will tell you to get out. The intelligent investor has already written the answer to those lies before they ever arrive. Your actionable takeaway is powerful and practical. Build what Graham calls a war chest. Keep a portion of your investment funds in cash or conservative bonds at all times, not because you know when the next crash is coming, but so that when it does come, you are positioned to buy, not to panic. The people who get rich in crashes are not lucky. They are prepared. And preparation starts right now, not when the crash is already happening. Now, everything we have covered so far, the Mr. Market mindset, the margin of safety, knowing your investor type, controlling emotions, value investing criteria, and thinking differently about crashes, all of it comes together in the final and most important lesson of this entire book. Lesson 8, the one decision that separates the wealthy from everyone else. Here is a question that sounds simple but goes very deep. What is the difference between someone who builds real wealth over their lifetime and someone who earns good money their entire life but never really gets ahead financially? It is not income. Studies consistently show that high earners without financial discipline go broke. It is not intelligence. Some of the smartest people make catastrophic financial decisions. It is not luck. Luck fades. Wealth built on real principles does not. The difference is one decision. The decision to think like an owner, not a speculator. Benjamin Graham's entire book comes back to this single idea. When you buy a share of stock, you are not buying a ticker symbol. You are not buying a number on a screen that goes up and down. You are buying a piece of a real business, with real employees, real products, real customers, real earnings. The moment you truly internalize that, everything changes. You stop caring about what the stock did this week. You start caring about what the business will do over the next 10 years. You stop reading headlines looking for trading signals. You start reading annual reports looking for business quality. Most people get this wrong their entire lives. They treat the stock market like a casino. They put money in, they hope the number goes up, and they pull money out when they are scared. And they wonder why they never seem to get ahead. Here is what the intelligent investor does differently. They do 3 specific things consistently. First, they buy businesses they understand. Not the flashiest sector. Not the trendiest industry. Businesses they genuinely understand well enough to explain in simple sentences. Second, they buy those businesses at a discount to their real value. They are patient enough to wait for Mr. Market to have a bad day and offer them a bargain. Third, they hold those businesses for the long term. They do not check prices every day. They do not react to every headline. They trust the underlying business, and they let time do the heavy lifting. The secret is that time is the most powerful force in investing. A 12% annual return sounds modest, but applied consistently over 30 years with reinvestment, it turns a single investment of $10,000 into nearly $300,000. Not because of genius, because of patience, discipline, and the willingness to think like an owner when everyone else is thinking like a gambler. Here is the most powerful takeaway from this entire video. Benjamin Graham was not trying to teach you how to get rich fast. He was trying to teach you how to avoid being poor, how to protect what you build while growing it steadily, how to use the market's irrationality as an advantage instead of letting it destroy you. The intelligent investor is not the one who knows the most. It is the one who panics the least. It is the one who buys when others are selling. It is the one who says no to 100 tempting bad deals while waiting patiently for one great deal. That investor does not need to work harder. They just need to think differently. And you now have the foundation to do exactly that. Warren Buffett read this book at 19 years old with $74 in his pocket. Today he is worth well over $100 billion. He has given credit to Benjamin Graham more times than anyone can count, not because the book gave him hot stock tips, because the book gave him a framework for thinking about money that protected him from his own worst instincts while positioning him for extraordinary results. That same framework is now in your hands. Not as an abstract idea, but as a real practical set of principles you can start applying today. Buy businesses, not stock symbols. Demand a margin of safety. Know your investor type and stick to it. Control your emotions before they control your portfolio. Welcome market crashes as opportunities. And above all, think long-term when everyone else is thinking about next week. The intelligent investor is not born. The intelligent investor is built, one good decision at a time. And your first good decision was watching this video until the very end. If this video gave you even one idea that shifts how you think about money, share it with someone who needs it. Because the best investment you can make right now costs nothing. It is just passing on a great idea to someone you care about.